We're not really behind schedule. What our proposal is to do, to introduce the speaker who will give his presentation, approximately half an hour, and then we will open up to a lot of questions and discussion about that for half an hour, and then you could kind of break it up and fight it out or discuss other things individually as you wish and make a happy merriment, and then we just sort of conclude, because this is, after all, the beginning of a week. So, it's my pleasure to introduce Daniel Brackins, who for a short time was a U.S. congressional candidate. He's from Japan. He did a great deal of study there, which perhaps he'll enlighten you a little bit more about it on. And he's an MBA student at Hawaii Pacific University right now, and he gives his professors a very tough time. All the time giving them a grilling on some flaws that they may have in what they're teaching. I've never run across a better and more articulate person who was able to explain a very good analysis of what the economic crisis is. And so I introduce you to Daniel Brackins.
Hey.
Oh, and he's from Germany. Yes.
Yeah. Originally from Germany. Okay, it's a pleasure. Can everyone hear me back there?
Yes.
Good. There's actually, I have a handout. If everyone didn't get it, there's some on that table right there. I don't know if there's enough. If not, then you could probably share. I didn't expect this many people, but... So basically, to talk about the financial crisis is a very complicated matter, but it's actually really simple. It's actually been overcomplicated, in my opinion, by the media and by politicians. And this handout kind of breaks down in more detail what I'll talk about, since in the 20 to 30 minutes I have, I can't go over every single detail. But I'll be talking about, a lot about the Austrian business cycle theory, which is on this handout as well. And if you don't have it, I can just give me your email, and I can email this to you as well later on. Then I will go into, as later, the market-based solutions to the market or the financial crisis, and what you can do as an individual to secure your finances in this crisis. And then there's also some myths that I want to go over. So as you can see, it's like a lot of stuff. So I'm going to kind of go through it, and hopefully the question and answer session will flush out what most people are interested in. So just to start off, we have to go back into history to understand economic and monetary policy in the United States. And I like to go back to 1913, because that's when the Federal Reserve Act was created. Went into effect a year later in 1914. The Federal Reserve Act, as you know, established the Central Bank of the United States, and it controls the monetary policy and our currency in regards to, it uses various operations. One of those is interest rates. It can increase interest rates to increase the monetary supply, or the amount of money that's flowing through. And so this is a lot of review for many of you, I'm sure, as I know the people out here. So what does the central bank do, and what is the problem? It creates money out of nothing. That's the main thing that it does. We used to have a gold standard. Our currency was backed by a hard currency. Actually, every country in the world had a gold standard up until, well, everyone got off at certain times. But what we have now is just the good faith and credit of the United States. So my belief is that the central bank, the Federal Reserve, created the financial crisis, as it creates every financial crisis, as it creates every depression, and so forth, every recession. And to go into that, let's go back to 2001, 2002, because I think this is what the current financial crisis stems from. As you can remember, we had an internet bubble back at that time. It burst. And if you can recall some of the policies that were being, conducted by the U.S. government, one of those things is they were afraid of entering into a deflationary situation. So they lowered interest rates. at that time. And by them lowering interest rates, what that basically means is they put more money into the economy. So you have an inflation, ongoing inflation. The media will have you say that inflation is a good thing because deflation is bad. And I'll go into later about why deflation is actually not a bad thing and it's a good thing. So what happened then in 2001, 2002 is you have now this expansionary credit cycle that's starting to begin because of artificially low interest rates. And so the way the Federal Reserve works is you have individual banks. Each individual bank, your private bank, your Bank of Hawaii, and so forth, they must keep a certain amount of reserve currency at the Federal Reserve. 10% actually is what it is. And the rest they can create, they can inflate, as long as it's based off of that 10% that's in deposit. So what happens then is, because it's not real money, not backed by gold, you have an artificial expansion of credit. That artificial expansion of credit is then passed on to the consumer, such as you and myself. In this case, it was homeowners, which we all hear about. We all hear about the real estate bubble that burst recently. These homeowners, these banks and lending institutions, were loaning money, malinvestments is what we would call them, to unworthy not creditors, but debtors, I would say. So these debtors who have bad credit and so forth were getting homes for literally no money down, things like that. There's stories where you have university students who would actually purchase a home instead of living in the dorm because they felt that the appreciation of the home's wealth would pay their tuition fees. Part of that is, why do you have an appreciation of wealth in the real estate market? It's because it's a false creation of wealth. It's artificially inflating. So whenever you heard people talking about, oh, you can buy this house now for $200,000 in 5 years, it's going to be worth $500,000, $600,000. That is an artificial expansion due to the credit that the Federal Reserve and the banking institutions were creating. So essentially, because there was no risk involved, people were loaning out as much money as they could, and if you couldn't pay it off, you could just remortgage your home, get some more money, because everyone thought that your home was appreciating in value. You could just reuse that money over and over. But essentially, it was all based on a house of cards because it had no foundation. So eventually, we have to believe that it's going to collapse, which it did, and we saw a lot of that last year with the stock market. Part of the things you'll see is, I go through this, actually the Austrian business cycle here in the stages on this handout. And for those, I'll just list them off just in case you don't have it. One is banks grant new loans on a massive scale and interest rates drop, which is what I just discussed. Credit expansion drives malinvestments in projects far from consumption, which were not profitable before the credit expansion. So as I mentioned, people were borrowing money without any risk. There was no risk involved, so people were investing in things just hopefully they would make some money out of it. If not, it didn't matter because it wasn't based on anything solid. 3, capital goods rise in price. And actually right here that the house prices rose by 40% on average between 2002 and 2006. So your capital goods are appreciating again because of that malinvestment of your artificial credit expansion. And I'll talk about later how there's a difference between consumption and production. And part of the reason is that our culture has gone into a consumerist type of behavior. If you look at our national balance of payments, we're at a very negative deficit. That's because we're not producing anything. We're importing everything from other countries that are then, they're the producers. So what we essentially have now is that artificial credit expansion helped create a culture of consumerism. Number 5 is the capital structure was artificially lengthened. That's again just again,